Um, you can just so when you're an options writer, right? You're writing naked calls, which means you're not. So you as a retail investor, you generally like you write covered calls, or secured contracts, right? So if you write a covered call, it's because you own 100 shares of the underlying that hedges the assignment of that call. If you write a cash secured put, you have cash on hand to cover the loss. Um, as a market writer, you're writing naked calls and puts, and these have infinite risk, right? So, if you write a naked call at a premium of like five, and the price of the underlying goes up, and IV spikes, and that premium continues up, the loss here is potentially infinite, right? And since it's leveraged, the loss occurs at 100 times the rate. So if you've written 20,000 contracts for GameStop at on the call side, and the price goes up, you know you're you're losing money at a rate of what, 2 million%, right? So your margin your margin is just gonna blow up super fucking fast. FTD's out, cool. Sleepy math, yeah, it's probably wrong. I just can't think right now. No, that is 2 million, right? Yeah. Yep. So for that would mean that for every dollar increase past the strike, they would lose, and this is not even counting IV, right? So this is why they don't. This is why they hedge, because they're fucking, because it's actually retarded not to. Like there's no there's no if, ands, or buts about hedging. Now they can hedge a little less, right? Instead of being truly delta neutral, like say you have a contract of zero point 0.4 delta, um, or 0.54, right? They might hedge like zero point 0.3, right? Because they think that the price is going to come back down, or they can drive the price back down. So they may not hedge the full value, but they're definitely hedging. Now, the advantage to us is, since we know they kind of don't hedge the full value, right? If they only hedge zero point 0.3 out of 54, right? And this value goes up to 1.0, right? This contract goes in the money, but they've only hedged, say, zero point 0.5, and then we exercise. They then have to immediately find 50 more shares to complete that hedge. Hey, look, negative beta. Yeah, sure, not a problem.